Singapore bank stocks are ending 2025 near record highs. DBS has pushed up to around $56 with no signs of slowing down. OCBC has crossed $19 and has set new highs as well. And even though UOB has clearly lagged behind the other two, it is still trading well above its pre-pandemic levels. This is where things start to get interesting. Interest rates have already begun to come down, and valuations are no longer cheap. Most Singapore banks are now trading well above their long-term price-to-book averages. In a typical bank cycle, you would expect that bank prices to have gone down by now. And yet, that has not happened. Instead of dropping, the bank stocks have continued to go up higher. So, why have Singapore bank stocks not dropped yet, despite the falling interest rates and higher valuations? And more importantly, what could happen next from here? Let's find out in this video. Now, one of the key reasons Singapore banks have held up so well despite falling interest rates and stretched valuations is the way their earnings mix has shifted in 2025. In a traditional bank cycle, bank profits tend to move largely in line with net interest margins. For example, in 2019 and 2020, when the US Federal Reserve cut rates sharply from 2.5% to 0.25%, all three Singapore banks saw their net interest margins decline, which resulted in the net income to fall as well. Then, from 2021 to 2023, when rates rose aggressively to 5.5%, the bank's net interest margins expanded again, which drove up bank profits. So, by that logic, now that the rates have been going down, you would expect bank profits to fall, right? Well, yes, but no. Sure, net interest margins for all three Singapore banks did start to come down. However, their net income did not collapse. Instead, their profits largely remained stable. Okay, UOB did see a sharp decline, but that was largely driven by proactive provisioning related to China and commercial real estate exposure, rather than a sudden breakdown in its core business. So, if net interest margins are falling, how come their profits did not fall? Check this out. In the third quarter of 2025, DBS showed that net interest income fell by about 6% year-over-year. However, at the same time, its fee income, treasury income, and margin trading income all went up. In other words, DBS non-interest income is now starting to contribute more towards the business. OCBC showed a similar pattern. In its latest earnings results, non-interest income rose by about 14% year-on-year, and now accounts for close to 41% of total group income. So, a much larger portion of OCBC's profits now comes from wealth management fees, transaction banking, and markets-related activity, rather than pure interest income alone. Same for UOB. Even though its net interest income dropped, its net fee income as well as other non-interest income have largely helped cushion the drop. What this tells us is that Singapore banks are starting to look less like traditional lenders and instead more like diversified financial platforms, where the earnings are becoming less and less dependent on where interest rates are and more dependent on client activity and assets under management. In some ways, this trend is starting to resemble overseas banks like the Bank of America, where a significant portion of its earnings now comes from wealth management, payments, cards, investment services, and markets-related businesses, rather than just traditional lending. And this is an important point because when a bank's earnings comes more from non-interest income, price-to-book ratio alone is no longer a sufficient way to think about valuation, because book value will mainly tell you how much equity sits on the balance sheet and how much money the bank can potentially lend out. But what it does not tell you is how effectively that equity is actually being used to generate profits. In that situation, it will also be helpful to look at the return on equity as well. To put it simply, ROE measures how efficiently a bank is able to convert its equity into earnings. So, if we look at all three banks' ROE, you will see something interesting. In the past, DBS ROE used to sit at around 11% to 12% for many years, but in recent years, its ROE has been climbing up, reaching as high as 17%. As for OCBC, the improvement is more modest, but it is still decent. Its ROE was previously under 10%, but in recent years, it has moved up to around 13%. Meanwhile, UOB ROE has not shown the same level of improvement. That partly explains why the market has been less enthusiastic about UOB as compared to DBS and OCBC. Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my interactive brokers link to open an account and start investing today. Alright, let's get back to the video. So, does this mean that UOB is a lousy bank? The answer is no. The main reason UOB has lagged behind DBS and OCBC is not because its core business is broken, but because it chose to be more conservative in how it is managing risk. So what's currently happening is that UOB has a relatively higher exposure to commercial real estate in Hong Kong and China, where property prices have been under pressure. Not only that, its non-performing loans for these two regions have also been inching up, going from 1% in 2024 to close to 3% now. As a result, in third quarter 2025, UOB took about $615 million in additional general provisions as a buffer against potential future losses, which contributed to a much larger total allowance for credit losses for the quarter and caused a sharp decline in net profits. However, it's also important to note that despite the weak profits, UOB's underlying fundamentals remain healthy. For example, its common equity Tier 1 capital ratio remained healthy at 14.6%. Its overall non-performing loan levels remain stable at 1.6%. Its fee income has continued to grow, which helped to cushion the impacts of lower net interest margins. On top of that, even with this preemptive general allowance, the CEO has confirmed that its dividend payments would not be affected, and the bank is expected to maintain its dividend payouts ratio at 50%. Not only that, the bank will also remain committed to its $2 billion share buyback program, with nearly a quarter of it completed as of September. But then, here's a question. If Singapore bank earnings are increasingly driven by non-interest income, especially wealth management, how long can this trend realistically continue? Over the past 4 years, Singapore has seen rapid growth in the number of family offices, rising from about 400 to over 2,000 today. That is a massive increase in such a short period of time. At the same time, Singapore's assets under management have crossed $6 trillion for the first time. And it is not just about size either. According to a Bloomberg intelligence survey, about 1/3 of respondents in Singapore expect assets management growth to continue by 11% or more per year, all the way to 2030. This tells us that the industry itself still sees a meaningful runway ahead, and this is not just some one-off post-pandemic surging. However, at the same time, after the high-profile money laundering scandal in 2023, Singapore regulators have also started tightening its regulatory checks on wealth inflows. This led to applications from mainland Chinese clients to fall by about 50% as compared to 2022, as banks and regulators become much more selective about source of funds checks and onboarding standards. Now, to be clear, Singapore still welcomes legitimate wealth, but given that the process is now stricter and more selective, the volume of new inflows will naturally reduce. Because of this tighter scrutiny, some wealth has begun to diversify to other hubs. Places like Hong Kong, Dubai, and Japan have begun gaining their share of new wealth flows, as high net worth individuals are now spreading their assets across multiple regions instead of concentrating everything in one place. At the same time, there are reports that China-related outflows are expected to slow down from 15,200 last year to 7,800. This seems to suggest that the outflows are returning back to their normal levels. So, what does this mean for banks? This suggests that the wealth management growth is likely to continue, but at a slower and more sustainable pace. If anything, the explosive growth phase driven by easy inflows is probably already behind us. However, the base of assets is now much larger and stickier than before. For banks, this still matters, because even if new inflows slow down, recurring fees from assets under management, advisory, and transactions will still continue to provide a steady source of income year after year. So then, is now actually a good time to buy Singapore bank stocks? Obviously, this is not financial advice, but here's what I think. Based on consensus estimates, the room for further gains is still there, but not high. For DBS, the median and average target prices from analysts are both around $58, which implies only very modest upside from current levels. For OCBC, the picture is even tighter. The median target price suggests that there's currently only around 1.2% upside, while the average target price implies roughly 1.8% upside. In other words, most analysts think that OCBC is already trading close to their fair value. As for UOB, the expectations are slightly better. The median target price implies that there's about 4.1% upside, while the average points to around 1.1%. This shows that UOB share price might improve once its earnings return to more typical levels. So yes, there's definitely still upside left, especially as bank earnings continue to remain resilient and wealth management continues to support non-interest income. Not only that, as dividend-paying companies, dividends do provide real supports to the share price. All three banks are currently offering a dividend yield of around 4 to 5%. That is quite attractive, especially right now where risk-free rates are starting to come down and high-quality income is getting harder to find. However, we also have to be realistic. At today's valuations, the downside risks matter more than before. Any negative surprise can have a bigger impact on the share price. For example, a sharp global slowdown could weigh on loan growth and reduce fee income. Renewed stress in China's property sector could spill over again, especially for banks with regional exposure. If wealth management activity slows down more than expected, earnings growth could also flatten. And on top of that, after such an incredible run, valuation-driven profit-taking is always a real possibility. But then some people might say, but with a 5% dividend yield, you get paid to hold the stock war. Yes, that is partly true. But it's also worth remembering that dividends are not free money. When a company pays a dividend, that cash comes from its earnings and balance sheets. Though in the case of Singapore banks, this is less of an issue because they are well capitalized and have committed to certain dividend payout ratios rather than reinvesting the excess capital. But still, this does not eliminate price risk. What this means is that if you already own these bank stocks, especially if you bought them at a lower price, there is no strong reason to sell them. They remain solid businesses with strong fundamentals and very stable dividends. But if you are buying at today's prices, this is where you need to be very careful. If the share price pulls back sharply after you buy, even if you collect dividends every year, you could still end up waiting for years before the price fully recovers. Not saying it will crash, but just saying it is a possibility. But knowing my luck, Singapore bank stocks could still continue to go on much higher from here. But personally, this is just my view. I would rather focus on other stocks first, where the upside is much clearer and the valuation risk is lower. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.